Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Michael Wilson, thank you so much for joining this morning. You call it a new bull market, and you say you have a higher conviction into 2026. Why?
Yeah, thanks, Tom. We talked about this in our mid-year outlook going back to May, which we felt like the April lows would be a durable low for a lot of different reasons. I'll try to go through them in no specific order. But we've had the view coming into this year that it was going to be a tough first half because earnings revisions were coming down pretty sharply for a lot of reasons. Most notably, the AI CapEx cycle was decelerating. We still had what I would call a rolling recession in many industries that were struggling, and the revisions were coming down. So what tariffs did was it sort of culminated that decline into April. And as you know, you've been around the block like me. Markets bottom on bad news. Okay, and so that I would have likened the Liberation Day announcement to sort of a natural disaster that basically, capitulated. Everybody capitulated. So that the revision factors, the main driver why we're bullish, we think it's a bull market, is the revision factors for earnings have shot higher. And you've seen our note. Okay, so doesn't happen every year. Right. That is as extreme as we saw coming out of the COVID lows in March of 2020. Okay, it's as extreme as we saw coming out of 9/11. It looks like a recession. It walks like a recession. It priced like a recession. So that's it.
Right. Okay, this is a really critical question, folks. We all understand the Trump legislation, the beautiful bill, and all that as some form of stimulus forward, at least out 1-2 years, maybe 3 years. At Morgan Stanley, Mike Wilson, the key question is the linkage of potential rate cuts to equity enthusiasm. I don't have a straight answer on that yet. Can we link Powell or future chairman rate cuts into an equity lift?
Yeah, well, I think, as usual, the markets get ahead of this. And what the markets are anticipating now, the bond market and the equity market, that the Fed will be cutting sometime in the next, 2 to 6 months. And, even our house call is for no cuts this year, but then they have 7 cuts next year. That's like wildly bullish for equities. Okay, so, it's you almost have the perfect setup, Tom, because what you have now is lagging economic data, which is what the Fed uses to make decisions. And you already have the equity market and earnings revisions telling you what's going to happen. So, they're looking backwards, and they're going to be looking at lagging labor data, and then of course lagging inflation data, which should come down ultimately later this year, next year, and they're going to cut into that. But there's not going to be a knock-on negative effect for earnings revisions in the way that people kind of assume when you get that sort of decline in labor data. In fact, I would argue, because it's gradual, that we're going to see revisions go up because, when companies reduce headcount, it actually accrues to margins.
Mike, what is screening well for you now? I'm not sure if it's sectors that you guys screen by or different factors that you screen by. How are you looking at this market and maybe where opportunities might be?
Right. So we do both. We look at factor revisions, we look at sector industry revisions, and we look at the stock level too. It works in all those areas. And so we've been rightly positioned really since April to be overweight financials, industrials. Those are the 2 favorites, and also software to some degree. And those have been the areas where the revisions have been the strongest. And I think that probably could continue. And so at the end of the day, I do think the biggest opportunity going forward is the areas that have not seen those revisions yet. So let's talk about the industries where we've been sort of in this rolling recession: housing related, commodity related, some of the consumer goods areas, which are going to feel the effects of tariffs now. So in the very short term, we actually think revision breadth could come down a bit as some of these tariffs flow through the cost of goods sold. But that's just going to create the next buying opportunity, perhaps in these areas that have lagged, even small caps, because they will love the fact that Fed's cutting rates at some point.
Mike, one of the themes today and really for the last period of time has been concentration risk in this marketplace. It seems like only a handful of stocks are driving the performance. But I think what we're kind of coming to the conclusion of, or at least rationalizing, is because that's where the earnings growth is. That's where the free cash flow is. How do you think about that issue?
You're exactly right. I mean, the market's not stupid. I mean, like first of all, what drove the market lower in the first quarter? The Mag 7. You know why? Because the Mag 7 earnings revisions were terrible in the first quarter. We had an AI CapEx deceleration. We had questions around whether it's going to generate ROI. Revenue growth kind of decelerated a bit. So it happened for a reason, but it has nothing to do with tariffs. Okay, it has everything to do with just the natural evolution of this AI cycle that's going on. So I think coming out of the April lows, the reason why the Mag 7 led is, well, A, they're big and liquid, everybody loves them, but also because they were seeing a rate of change bottom in the revision factors. And I'll give you two huge catalysts for that. The weaker dollar, okay, which accrues to the large multinationals, particularly some of the Mag 7. And the second one was that we saw that NVIDIA could no longer they could no longer sell chips to China, and they took a big write down on inventory. But now they can sell those chips when the inventory is at zero. Okay, so what does that tell you? Gross margins are going to be basically manufactured for the next year. So there's a lot of reasons why stocks do what they do. But the main reason, our whole franchise, as you know, focuses on earnings, not lagging economic data.
Mike Wilson with us across your commute this morning, across the nation, I should say, on YouTube as well, in the office, and of course at home. YouTube, subscribe to Bloomberg Podcast, growing each and every day. Should we do a shout out right now for Joe Weisenthal, Tracy Alloway, killing it? Number one on Apple yesterday.
Phenomenal. Had a great write-up in the New York Times a couple of days ago.
And just, they'll be with us at Jackson Hole. Thrilled to maybe I'll get, maybe their entourage will let me speak to them. We'll have to see. Mike Wilson with us with Morgan Stanley. Mike, how do you use your analysts' work? Mr. Weiss covers Microsoft. Just as do you speak to these people, or how do you use the securities analysis of Morgan Stanley?
100%. We're a micro macro franchise. Man, I started my career in the stock business. I used to be a TMT specialist as a desk analyst, following bottoms up. And so I obviously know these folks. I've been here for 35 years. I know all of them well. Yeah. I've worked with all of them. And so every month we hold a call that we basically call it the micro macro matchup, where we basically kind of talk about our views from a macro standpoint. And then we talk to the analysts and say, well, what are you guys hearing? What are you doing? How are your numbers maybe adjusting? And that informs us, just like our analysis does from a top-down perspective. So the marrying of the micro macro, I think, keeps us a step ahead of most people. People can criticize us for various things, but they can't criticize us for I think we have done a better job of most of being in the right places within the equity market because of that micro macro marriage.
So delve here now into, say, I see MIT Sloan, I see Caltech, this whole cottage industry, including University of Michigan, Ann Arbor, doing AI, learn about AI. At Morgan Stanley, what is the next 3 months, 6 months zeitgeist on AI, the momentum of it?
Yeah, well, here again, I have an advantage because we have some analysts who are not only very good in this space, and they have long tenure. Like a lot of our tech analysts have been in the seat for 10 to 20 years, and so we have continuity there. But the zeitgeist here is essentially now into the adoption phase. We've written a lot about this, which is that these tech cycles, there's basically an enabler phase where you have a build out, and the enablers benefit from that build out. And then the technology gets adopted by the early adopters. We're seeing that mainly by the hyperscalers, quite frankly, because they're very facile with the big data sets. And then ultimately what we think is going to happen, the application layers being built now that will then be basically diffused out into the broader economy. And so that's where it gets really exciting. That's sort of the internet. When the internet got exciting is when it started to make everyday businesses more productive. So we have screens, we have lists. We've been publishing on this for quite a while. Those AI adopter stocks are massively outperforming. They have been. The market knows this. I think we've been ahead of that curve, and that's what we're looking for the next 12 months. This is when we're going to start to finally see some of the productivity benefits diffused across the broader economy. It won't be a straight line. There'll be doubts and fears and uncertainty, but it's a very positive story for the 2026 earnings story. And this is why stocks are not as expensive as people think, because the market figured this out just like we did. I mean, if we can figure it out, definitely the market figured it out, that we're going to see positive revisions lead to better earnings growth next year. Okay, and I think the economic data is backward looking, and it just doesn't tell that story.
And that denominator, Paul, comes up. Yep. That's the whole thing.
Yep,
it's amazing.
Hey, Mike, in your research note, you write, since the lows in April, the rally in stocks has been relentless with no tradable pullbacks. What creates a a pause in a bull market where you can maybe catch up a little bit?
Well, we tried to lay that out in our note this week, right? Just because we want to be well balanced here. But I want to go back and that comment about the market being relentless and straight up and no pullbacks. Those are the characteristics of a new bull market. That's what happens, and that's what it looks like. This looks exactly like April, May, June, July of 2020. In fact, it's following a similar pattern. So I think the things that could get us a consolidation in the third quarter, which we did start writing about, a couple of weeks ago, we said there's going to be a pullback. It's going to be during the third quarter. We don't know when, but we do think there's 3 or 4 potential drivers of that. Number one, revision factors could come down as the tariffs start to flow through the cost of goods sold, right? The more expensive inventory starts to flow through, and some companies will have margin pressure with that, or there'll be some demand destruction. That's one. I think number two is we know there's a tremendous amount of supply coming on the Treasury issuance side. Maybe the term premium kind of pushes out again, and we get a backup in long rates. The market now is negatively correlated to rate at this point, so that's another potential driver. And I think the one that is not so obvious, but has been a big driver of the bull market, the new bull market, is the dollar weakness. So dollar weakness has not only translated to better earnings growth for the multinationals, it's also added an incredible amount of liquidity to the tune of about $8 trillion to global money supply. So if the dollar were to strengthen here 5, 6, 7, 8%, that could lead to a liquidity drain of some kind and a pullback of
Interesting.
Of
Fast. I should point out, Mr. Wilson talks about the lift off of 2020. That was precisely 100% in 22 months out to the end of 2021 was the first leg of that lift. Absolutely extraordinary. Mike Wilson, I got to go to one of the dogs. I noticed it on the WEI screen today. Health. I mean, is it health a value trap? How does Morgan Stanley consider purchase of health equities?
Well, it has been one of the worst performing consistently sectors. Even when the market was somewhat defensive in the first quarter, it didn't really do its job. And I think we can attribute this to a couple of different things. I would say most notably, we have a new, obviously, head of the HHS with Robert Kennedy Jr., who has been, I would say, quiet so far on what his main initiatives are going to be. And I think there's just sort of some fear there that maybe it's going to be draconian in terms of like for pharma companies and some of the device companies and even the insurance companies. And I think it could be this simple, Tom, is that once RFK Jr. and the HHS roll out what they're going to do, I think they've said September they're going to be done with some of their studies. It could just be a sigh of relief. Mm-hmm. Maybe that's the catalyst here, but I mean, we're not going to probably upgrade the group until we see at least a bottoming out of relative earnings revision breadth. We're just not seeing that. And so there's no need to go there. There's other things to do.
Paul, I got good news. I checked the schedule. Duke does not have the privilege to lose to Michigan this year in football.
Very good.
It's a constructive first step for Duke. Mike Wilson, thank you so much with Morgan Stanley.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Anastasia Amoroso with us now with Partners Group. David Layton running the charge there. Partners Group, of course, doing a lot, particularly more out west and in Switzerland as well. You're still based in New York, right?
I am.
But Partners has a huge international perspective, right?
That's right. We're a global private markets firm. Been around since 1996. Zug is the headquarters. Denver is the U.S. headquarters.
Zug, that's how you pronounce it.
Zug, yes, outside of Zurich, and also in Denver as well, but also a really big presence in New York as well.
Very good. Thrilled to have you back with us. The level of Amoroso courage to stay in the market at different points. Do you feel that way right now where there's so much geopolitical nervousness and all, and you're just saying fight the good fight and stay in the market?
Well, Tom, one of the probably the best perspectives I've gotten, throughout kind of my investment tenure is that thinking about themes and thinking about the megatrends that really change and shape the world for years to come. And if you align yourself with those, and if you focus on what actually drives earnings or what drives profitability, it's focusing on things like artificial intelligence or digital transformation or healthcare innovation or, new ways of living. So that's what sort of gives you the courage to stay through the next rate cut or rate hike or not, or through the next inflation report, if you invest in the right kinds of companies in order to benefit from that innovation over time.
One of the big themes that I guess, become more accustomed to over the last 6 months, 12 months has been maybe this onshoring, reshoring, this reduced sense of internationalism. And for a company like yours, it is a global company in Zurich and in the US and all over the world, how do you guys think about the fact that this may be a less global economy than it was 1, 2, 3, 5 years ago?
I don't know if that is a completely right assumption to make, that this is a less global economy. I don't think the objective is really to sever all trade ties. I think the objective is really to rethink the trade going forward, and also to sort of set out new rules of how the trade is going to be done. So if that's the base case scenario, as investors, we have to think about how do corporations, how do consumers, how do we want to adjust to that? And, speaking of adjustment, this is why I call this the quarter of adjustment. This is the time where companies are going to decide whether they're going to pass through the tariff cost to the consumer, or they're going to...
Well, what do you see there? What's your update?
We see a combination. I think the vast majority of companies, about 75% of companies, are saying that they're going to pass through the cost to the consumer. Maybe only 25% of those say it's 100% of the pass-through. Some of it will be absorbed by the profit margin, which is near record.
Anastasia Amoroso with his Partners Group. And again, thank you for joining us on your commute this morning across the nation, in the office, at home, in Zug, Switzerland. YouTube is the way our new distribution is subscribed to Bloomberg podcasts. We protect the copyright of all of our research. They email it. Send us Anastasia's note. No, get it from Partners Group. I love how you say this. Focus on what you can control. Describe that for equity market investors right now.
Well, the first thing you can control is the kinds of companies you invest in, and what are the profit margins, what is the starting point for those profit margins, and what is the end point, what you're trying to achieve. So one thing we can control is actually growing that profitability and growing the profit margin. It's driving operational efficiencies. It's perhaps infusing AI, machine learning, and other productivity tools to grow those margins. It's building platforms rather than, let's say a one product business. So that's one thing you can control. The other thing you can control is you can pivot into the sectors where you do naturally have faster earnings growth, because it is not a company that's aligned with the old economy, but it's a company that's aligned with a new economy. So that's why we do look to things like data centers. That's why we do look to the build out of the energy production as well. So those are the things you can control. You can control leverage. How much do you use? And how do you, pull that lever based on what interest rates are? So those are some of the main things.
Outside of tech, which is obviously driving this market, are there areas outside of technology that you guys find interesting?
Yes. I think one of the misnomers in the markets right now is that just because there's not a big focus on sustainability from the current U.S. administration, then this is not a theme that's going to be there. And, I very much think that sustainability is a theme is here to stay, because it's really about how can we be the most efficient with our natural resources, minimize the damage to the environment, also make sure everybody has access to basics, which basics in today's days and age means a data center powered by some sort of electricity production. Well,
let me interrupt. This morning, Apollo Funds comes out and says we're buying data centers, and they're buying stream data centers.
Yeah.
This is Joseph Jackson and Trevor Mills at Apollo Partners, and that's exactly it. Where private markets are coming in.
That's right.
To finance this huge capital investment, right?
Well, it's a great point, and here's the reality. Everybody's been talking about data centers for a while, and yet if you look at the occupancy rates for data centers, they are near record highs, and we still think that sort of the peak occupancy of data centers is still a few quarters away. So that means for the time being, you still need to build out additional capacity, and supply demand for data centers is still going to be tight for a period of time. So that gives you the ability to control the price, and also the investment has to continue as well. And by the way, just another point to add on that, just real quick, data centers are thought right now for, to be used for cloud and also training AI models. But, Tom, the next phase of data center growth is really the inference stage of it and applying those trained models into another use case.
Talk to us about valuation in this market. It's tough here because if you just kind of look at the S&P 500, it's expensive. But if you start making adjustments for some of these technology companies, the Mag 7 of the world, maybe you could make a case that it's not that expensive.
Right.
How do you guys think about that?
I mean, it's true that Mag 7 versus the rest is a very different scenario. But I will say that even the cyclical sectors, for example, I looked at industrials the other day, and even industrials, the discount to the S&P 500 or for machinery, that was actually the case, the discount has narrowed. So I think broadly speaking, valuations in public markets have got a long ways in a short period of time. Having said that, in private markets, that's where we are still finding cheaper valuations. And if I look at the S&P 500 EV to EBITDA, we're probably close to 17 and a half times. If I look at private markets, we're about 12.2 times for US EV to EBITDA in private markets. So that's why we're obviously quite focused on capturing the valuation in private markets.
This may be delicate. I don't want you put in jail in Zug, Switzerland. But there's a lockup to private markets. Are you seeing, there's an article in Carlisle this morning where they're jettisoning finally a lot of properties in the buoyancy that we're in right now. But do you see liquidity within private markets that makes up the liquidity penalty going from EV to EBITDA up to down?
Right. Well, liquidity is a big concern. I think one in private markets investing, and I think one of the things that Partners Group has done for a long period of time is manage that liquidity for clients in an evergreen solution. And what I mean by that, and what I mean by that is clients have the ability for quarterly liquidity if they need to, and the reason we're able to do that is because not only do we focus on direct control investments, but also secondary co-invests, and that really, having managed this for about 16 years, it's been through multiple cycles, and liquidity has been there for clients.
Can I do an audible?
Sure.
Okay. You mentioned evergreen solution. Do you have a real Christmas tree or a fake Christmas tree?
I always get a real one every year.
Thank you. Yes. The biggest argument.
Was that the right answer?
The biggest argument me and John Farrow have had. I go over to Farrow's. He's got the fake Christmas tree with a light thing spinning around at the bottom.
Yep.
I'm like, John, it's un-American. You got to have a real tree. Okay, so that's our evergreen solution. Here, Paul, continue. I got waylaid there.
Private credit, it's been such a big part of the alternative investment theme over the last 15 years, I guess, since the financial crisis when it really got big. How do you guys think about private credit alongside your private equity and your other businesses?
Sure, it's a really important part of the solution suite. And look, if you think about bank share of private credit of lending, it has stepped down from about 74% back 20 some years ago to about 25%, depending on the quarter. And it's been the private credit providers that have stepped in and provided the liquidity and plugged in that gap. So now about 75% of the market is actually driven by private credit. So look, from a market perspective, whether we get a rate cut or not from the Fed, I will say the excess spread that you get in direct lending, for example, of on average about 500 basis points is quite attractive, especially if rates keep heading lower, private credit screens well.
In the time left, I got to get some SPX vision from you. How far up forward are you in the stock market? How do you frame end of the year or even 12 months forward right now?
Look, I think we're in for a consolidation quarter, this quarter, at least until September 17th, which is, of course, the FOMC decision. And I say that because we're going to hear a lot about the tariff impacts on net profit margins. And maybe some of that is going to be offset by, the labor market is weak, therefore the Fed is going to cut. So I expect choppiness. But as I think about the fourth quarter and into 2026, Tom, I think what doesn't get talked about enough is that we did pass a tax bill that's quite favorable for the consumer, but it's also quite favorable for businesses as well. So whether it's 100% R&D expensing that has now been made permanent, or 100% depreciation that has also been made permanent.
I think this is underplayed, Paul.
That's an incentive.
The stimulus impact. The cynics would say it's clearly around Republican reelection 26 and the president to 28. But the stimulus we're living right now is tangible.
It is tangible into 2026. We're not going to see much of it this year, but into 2026. And Tom, you know how the markets work. They look forward. So I think that'll be an important story in the fourth quarter.
But
it's still not out of the triple leveraged all cash.
No.
I know how the markets work.
Exactly.
One more, Paul.
So Anastasia, how's your job going to change, do you think, if at all, being part of the Partners Group now, which is such a large alternative asset manager globally with a view there.
Right. Well, it's certainly a privilege to be a partners group. And the role is really to help our clients think about how does the macro how are the macro forces impact your investment portfolio, specifically from the standpoint of allocating to private markets? So what does this combination of inflation to rates to growth to tariffs mean for investing in private equity? Where do we find some of the best opportunities within directs or secondaries? What does this mean for private credit, real estate, royalties, investment, and more? And the other big conversation is that I think a lot of clients understand and want to allocate to private markets, but for a lot, it's still a consideration of how and how much. So helping advise clients on the portfolio construct to private markets is an important one as well.
Anastasia, thank you so much. Her optimism on the American economic experiment. Ms. Amoroso with the Partners Group.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Stephen Auth joins us now, CIO Equities at Federated Hermes, and they've got different approaches there. But all you need to know is looking at the Federated Growth Fund. It's under the Authian umbrella, as we call it. I mean, it's sort of doing okay. 3-year, 95th percentile. 5-year, 99th percentile. They're off the mark then. Not too bad. And this is all the growth juggernaut, and this is what Steve Auth is acclaimed for worldwide. I want you to explain in this unique year how you approach equity investment, knowing, like baseball, 25 or 26 or 28% of the stocks will go up and the rest don't. Forget what stock to pick. How do you choose not to own a stock in the S&P 500?
Well, I think it's our time horizon that's a little different, right? The most traders today are focused on day-to-day movements. We're too big to even think about it that way anyway, but I think it's not really the path to success in the investment markets. We tend to look at a longer-term horizon, and that leads us to look through some of the noise. What's interesting to me, I think one reason we're having a pretty decent year here, and we did last year, is the news cycle has really shortened up. And so the folks chasing around the news cycle are like chickens with their heads cut off, getting whipsawed left and right. I mean, if you were following the news cycle in April, I mean, you went to cash.
Is that what hedge funds do?
I don't want to speak to the hedge funds broadly, but certainly that's one of the ways they try to make money. And they have a lot of folks doing it, and some of them do a good job at it. So I'm not knocking the hedge funds, but we tend to look longer term. And right now, that's helped us a lot, because one reason we were more optimistic in the spring was, to us, the gap between the soft data and the hard data was pointing to, we are in a little bit of a slowdown here, but we thought coming through it, things would get better. And once we got this uncertainty behind us this summer, and here we are right on schedule, you get a kind of bounce effect just from the uncertainty lifting, not to mention, the incentives to further investment through the tax cut. You've got the deregulation thing coming through. And, fortunately, the Fed is looking backward. So they're going to be cutting.
Right. Mm-hmm. Well, we got to remind ourselves, 1 year trailing, NASDAQ up 28%,
Mm-hmm. Yep.
S&P 500 at 20%, Dow up 13%. How many of our listeners and viewers, including me, understand, looking back 12 months, we got a double-digit 2-0.
Yep.
It's amazing.
Exactly right.
And often, by the way, that's a precursor of a pretty decent next 12 months, if you look at the data.
Yep. So, Steve, one of the concerns, particularly in the equity markets, is a concentration risk here. We've got it in the Mag 7 or whatever you want to call it. So much of the performance, so much of the valuation is concentrated in a handful of names. And people like Torsten Slok over at Apollo just kind of call out, well, we haven't seen that very often in the past. And when we did see it, late 90s, it wasn't a good thing. How do you guys think about that?
Late 90s was a completely different thing, though. If you look at the share of the top 10 versus the share of earnings of the top 10 on market cap, it's a flip-flop of the late 90s,
Yep.
right? Late 90s,
Yep.
we didn't have any earnings. These top 7 companies are terrific companies with enormous free cash flow that we think are reasonably valued. And within them, even there, I mean, what we're calling for is, as you think, is a rotation into the broader market.
Okay.
And that's going to help our stock pickers, by the way. But, that rotation has been slowed down by concerns that the world was going to end with all the tariff stuff and everything else. Now that it's not ending, I think those stocks are going to start to, and that's what's happening. We're already seeing the market broadening out here. The Mag 7 have had a good run. We like within that even some rotation, like a Google as an example. Stock we like. Great cash flow generator, trading at about 17, 18 times earnings for what you're getting.
Paul, you mentioned this, the Federated Growth Fund. This is the MDT platform out of Milwaukee. 47.4% in the top 10 stocks.
Yep.
That's so away from the textbooks that I studied years ago.
So, Steve, are there sectors that screen well for you these days? Are there factors that screen well for you these days?
That's a really important
How are you
question.
thinking about it?
We haven't asked that in ages.
Yeah,
Thank
exactly.
you. That's a Liz Ann Saunders question.
That is, exactly.
Yeah.
Factors.
Well, our MDT model that we use is multi-factored, and it's very complicated and probably too complicated to describe.
For radio,
here,
thank you.
But it really tries to imitate the way a human brain works. In a way, I'd call it, we don't call it artificial intelligence, call it machine learning.
Is this after the third or fourth Yingling beer? Continue.
But it looks for combinations of things that we like. And, we point to some combinations of things that look pretty good here to us. I mean, if you look at companies that are more cyclical in their nature and their backdrop, and then have good balance sheets and valuations that are still pretty cheap, those are the stocks that we kind of like here. Regional banks, some of the out-of-favor technology companies, some of the industrial sectors, defense. Defense stocks have had a pretty good run, but you have to look underneath the surface to find ones that make sense. But it's those kind of things now. A little more of a value tilt, perhaps even within growth. Like Google's a growth stock, but with a kind of value tilt to it.
Valuation, I'm sure you get pushback from your clients a lot about, boy, this market looks expensive here. How do you respond to that? Do you say, hey, if you back out these handful of names, the market's not that expensive?
That's exactly how we do it. In fact, what we started doing about a year ago was we started calculating what a fair value on the S&P would be if you did the math in 2 parts and then combined it. These big cash flow generators that are near monopoly businesses, that are in growth spaces, we think if you add that all up, they're probably worth like a 25 multiple. People's heuristic on what the market is worth is based in a world where the market average was 50% cyclical industrial type companies. And now that share of the market's probably about 30%, and you've got these big cash flow generators. So when you put them out there at 25 and you say, okay, call the rest of the market 18, you get to a fair multiple on the market of around 21.5. That's what we've been using in all our targets that have more or less been working for us. We're closing in on our target for this year now, which at one time seemed crazy. But
Got to get this in. Uber with a big share repurchase today. How's use of cash going among the anointed? Are they actually giving it back in share purchase and dividend?
we're seeing a lot of that right now, Tom.
Yeah.
And that's another reason that we're bullish on the market. Companies are throwing off a lot of cash here. And we're in that part of the cycle here where you're seeing that. And the buybacks are supporting share prices.
Seeing, am I right, 40% of free cash flow some of these companies are doling out?
Paying out. And in our dividend fund, we've got companies paying out 65, 70%. We like to see that in slower growing companies in the dividend fund. But, we like to see those big payouts.
Stephen O, thank you so much.
Thank you.
With Federated Hermes being with us today.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Douglas HoltzEakin was a huge value add for years and years. For some reason, over the last quarters, we have not had the expertise of Douglas HoltzEakin on the show. We're thrilled that he could join us in the American Action Forum. His public service with Senator McCain years ago, a GOP slant, yes, but always just exceptional scholarship out of Denison and Princeton. Doug, it's been way, way too long. Thank you so much for joining today. How far removed, Douglas HoltzEakin, is just traditional Republican economics and Republican labor economics? How far removed is it from President Trump?
This is an enormous shift in the Republican Party. I mean, it's almost unrecognizable from 20 years ago. And the characteristic of this era is that both parties are interested in using the power of the government as a cudgel for their purposes, and that's not a limited government personal freedom approach, not at all.
What is Kevin Hassett doing? I mean, I understand Pennsylvania doesn't have the quality of Princeton to the far, far north, but you and I know Kevin Hassett is a legit macroeconomist. How is he carrying water for the president? How do you see that, Douglas HoltzEakin?
I think that's a question you have to ask Kevin. I don't understand a lot of the Trump administration messaging on their policies. I certainly don't understand the strategy on their policies, and if Kevin understands it, I'd like to understand it better.
Doug, we had some fireworks at the Bureau of Labor Statistics last week when the jobs data came out here. Can you put that in context based upon your experience?
Well, the assertion by the president was that the commissioner rigged the data, and there's simply no evidence of rigging the data, and there's no opportunity actually for the commissioner to alter the data in any way if you look at the procedures that are followed. So it's a baseless assertion. It's something that I think is obviously detrimental to the institution. It undermines to some extent the credibility of the government's data, and you don't like to see that. And it was simply the White House trying to change the subject from the substance of the data, which is really poor jobs numbers over the past 3 months, to firing an official who's a holdover from the Biden administration. So it's an old playbook this White House has used a lot. I do think it has brought to the surface something that's really important, which is the diminishing potential quality of the data at the BEA and the BLS. And, now I think the general public understands that response rates have fallen, that the sampling sizes have gone down, and that initial estimates aren't as firm as they might be. So now the question is, will anyone get behind an effort to improve those data collecting efforts and strengthen those statistical agencies?
That's a good point, Doug. I mean, it kind of seems almost antiquated, going out and doing a survey in a world of digital opportunities here.
Yeah, can I say something about that, Paul? I mean, a lot of people brought this up. Like you should be tapping into the ADP or other payroll processors, but at some point, you actually have to do a census of things so that you understand what the weights are going to be on the ADP data. They census oversample large firms. So there is at some point the antiquated issue of going figuratively door to door and finding out what's out there, knowing what the relative composition of the labor market is, and that's an expensive and time-consuming process. But it needs to be done and be done better.
The hallmark of HoltzEakin work, folks, are single sentences that make you stop. May I quote? The non-education, non-health private sector has lost 46,000 jobs over the past 3 months. Good morning, Nancy Lazar, who's been brilliant on this. I don't think, Doug, that's understood, that private sector employment is terrible ex the gifts of health and education.
It's dead in the water and has been. I've been confused by the sort of positive reactions to the recent labor market reports because, even before the revision, when we got 147,000 jobs in the previous employment report, 70-odd thousand of them were in state and local governments. Of the remaining 70-odd, 58,000 were in health. It's the only place that was generating any jobs. Everything else is dead in the water. So When I look at the labor market, I see a labor market where no one gets fired. That's great, but no one gets hired either. It is at a standstill, and that's really quite troubling.
So how to fold that over to Fed policy here? I mean, go to 60,000 feet, if you will. I brought it up today for the first time. Are we at a point now where this is so emergent that in 1 week or 2 weeks, we're going to be talking about a 50 beep cut September 17th?
I don't think we do see the basis for 50 basis points because, the Fed has a dual mandate, and the Trump tariffs have really put the Fed in the crosshairs because the inflation pressures are there. The labor market's, really at a standstill. So the mandates are telling you to do different things, and how you balance that is an incredibly hard job.
Yeah.
People put different weights on, inflation versus unemployment. They do, and we don't know how quickly this is going to work. So
Paul, I got to interrupt, Doug. This is too important. Paul, get one more in here. But does HoltzEakin look like he could be a Fed governor?
Oh, how about that?
I promise you, he does not look like he's going to be a Fed anything.
Exactly. So, Doug, let's just kind of put a bow on this with a discussion of tariffs here. I mean, tariffs are here. They are here to stay, it looks like, and it's whether it's 15, 18, 20% on an average basis. How do you think that's going to play out through this economy over the coming 6, 12, 18 months?
So I think, number one, you have the right time frame. People have gotten too accustomed to the notion that a pandemic or a financial crisis hits the Main Street economy, and we see real quickly what's going on. This is going to evolve over quarters and years, not weeks and months. And so we really haven't seen the impacts yet. It is unmistakable that tariffs of this size, so roughly $300 to $350 billion at an annualized rate, that's a very big tax increase. It is going to put upward pressure on prices, no way around it, and it's going to take purchasing power away from consumers, and that's going to slow the economy. So at some point over that 6 to 12 month horizon, we're going to pay the price in inflation and slower employment growth, and we're starting to see that, and there's no way out of that. The only question is, how big will it be and how fast will it happen?
His blue tie is sort of a governor blue tie.
Sure.
I think it is.
Solid book.
Douglas HoltzEakin, thank you so much. Wonderful. It's been way too long, Doug. We got to get you on here numerous times before Jackson Hole. Douglas HoltzEakin is public service. It's CBO. He's a president of the American Action Forum.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lisa Mateo fired up with the newspaper. She's in at 3 a.m. On the news. What are you starting with today?
Okay, big sports news. So let's break this down. Okay, so the NFL is going to sell most of its media business to Walt Disney. This is in exchange for a 10% stake in the ESPN Sports Networks. Okay, so ESPN, jointly owned by Disney, they have about an 80% stake, and also Hearst Communications, they have a 20% stake. And what it includes, it's the NFL Red Zone. That's a subscription-based highlight service. The NFL Network cable channel, and also Disney's going to get air more NFL games. ESPN, though, is getting ready to launch this new streaming service that's going to cost about $30 a month. So the timing on this is pretty good. On top of that, though, the Wall Street Journal actually just put out an article that says Disney bought exclusive rights to many WWE's high-profile events for just over $1.5 billion.
The Sweeney cam is going nuts right now. You're over there squirming on this.
Yeah, I mean,
is this the future?
Well, it's a great move, I think, by ESPN and Disney just to cement its relationship with the NFL, with all the competition that is likely to come in for distribution from Amazon and all the other streamers. It just kind of
will there
anchors
be journalistic independence?
But yeah, I'm sure there will be. It's fine. They were already tied at the hip. Anyway, this just kind of codifies it. And again, in a world where there's going to be more and more competition to get that NFL programming, which is the most valuable in the world, ESPN's now got a really good position, I think. So we'll see.
I think so. I look at it and I'm like, okay, maybe I can cut the cable cord now because
I
all
think
my
you-
husband watches cable for is for the
Yes.
sports
Yep.
part of it, the NFL. But
It's
yeah,
just
we'll see if
sports.
that happens.
It's just sports.
It's sports. It's huge.
Next.
Okay, so this next story, I thought of you, Paul, because I remember
Yes.
you said you go to resorts
Never
and at
think
the
of
end
me.
of it, you get this big bill,
Yep.
right? All the kids' smoothies,
Yes.
like everything. So
killed me
more
for
people
years.
are enjoying these all-inclusive resorts, so where everything is included, so you don't get the big bill at the end. And hotels like Hyatt, Marriott, they're trying
I've
to get
done
the
this.
affluent, the affluent customers. It's going to run you maybe about $1,000 a night for
the
for
first
two.
year
Yeah.
I did it, and I kept very careful track, and I decided it was fair.
It was worth it.
It was, yeah, borderline worth it. But
Yeah.
the weight of not having the smoothie bill at the end,
Yep.
or excuse me, the rum punch bill at
Yep.
the end.
Exactly. So we're all in. We do it in Aruba every year.
So
every
this is
January.
you
building.
do?
Yeah.
This is building, Lisa.
So it is. Okay, so you have like Marriott, for example. They just bought their first all-inclusive W resort, Punta Cana in the Dominican Republic.
There you go.
Check it out. Last year, they had their first Marriott branded in Cancun. Even Hyatt, they have about 10 all-inclusive brands. So this is something that's really starting to build, but they're gearing it like they're putting it on steroids. You know, it's like, $1,000 for two people.
So would you
a
do
night.
it?
At that price, I don't know if I would. I don't eat that much. And I
She
don't
has a
drink
piece of
that
celery
much.
every day.
Are you
So-
doing when you go to a resort like that? Are you doing Pilates?
You have to. I go to the gym every day when I go on
See?
vacation.
Next.
Come on, Tom.
It's these people, they're a different breed.
Insufferable.
Okay, this one's going to get you fired up too. Okay, so this is Microsoft. They're getting this more strict return to the office policy. Sources telling Business Insider employees could be coming back more often. Okay, so right now they let employees work mostly remote as much as 50% of the time. Sometimes they're a little bit flexible.
Yeah.
But the new policy is going to require them to work in the office at least 3 days a week.
Oh boy, what a
Business Insider's
tough.
really doing a great job on this with AT&T.
Yes, they do. They get these
There-
inside
there-
insights.
There's just like Admiral Boom and the wind on Mary Poppins. There's something going on in August of this year.
Yeah. But it could
is.
because you've seen like a lot of, especially tech companies starting to do this,
Right.
like getting them more back to the
Okay,
office,
all right.
being a little bit more strict. But hey, 3 days, I don't know.
Lisa Mateo, thank you so much. The newspapers this morning.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.